My wife says I look like a picnic table in this shirt. She's right. My name is Reese, and today we are talking about 5 of the most substantial risks in retirement and how you can mitigate them, or at least try to. Now, when we're talking about risks in retirement, most people automatically think of investment risk or market risk. Simply put, this is the risk that your investments do not play nice with you. You don't get the kind of return out of them that you're hoping for, which of course can mean that you don't get the kind of money out of them that you're hoping for throughout your retirement. But to understand this kind of risk properly, we really need to break it down into at least a few different sub-risks. The first one is simply lame investment returns. This could be because the markets you've invested in just didn't do that well, but that's probably not the reason. There have been many market downturns over the years, for sure, but on the whole, global markets have actually delivered very pleasing returns over the long run, and that is a fact. I have a bunch of videos on this topic already, but if you're looking for the evidence right now, then simply go to this handy chart put out by the Ontario Securities Commission. Click Next, and that about sums it up. Markets have actually done really, really well, despite all the drama along the way. The more likely reason for lame investment returns is usually a combination of excessively high investment fees and your investment manager just simply not doing that good of a job. Now, I don't want to get too deep into this. Well, I mean, I kind of do because it's really important, but it's not the focus of this video. But I do want to nail this down with a bit more evidence for you. Check this out. This is the Spiva website. And in a nutshell, what this section of their site is showing us is the difference between paying investment managers to try to beat the market versus simply owning the market. And look at that. In Canada, over the last 10 years, 96.63% of investment fund managers have underperformed the S&P TSX, which is simply an index representing a huge chunk of the Canadian stock market. Nearly 97% of the time, you are better off just owning the market rather than paying someone to try to beat it. And just in case you're wondering, they haven't fared a whole lot better down south either. Anywho, this is one of the key reasons why we partner really closely with a portfolio management firm that invests our clients in exactly this way to capture the returns of the markets as a whole. We think, and as more time passes, there are more and more reasons to think this, that it is far safer and far more profitable to stop trying to beat the market and just start harnessing its growth. Let it do its thing. To put it simply, we can win by just not losing anymore. And I'm sorry I went a little bit off there, but we talk to a lot of Canadians and we see a ton of investment statements as part of our day-to-day work here. And high fees and low returns is actually really common. It is a widespread problem with an easy fix. But of course, those aren't the only reasons for lame returns. Another big one is lack of diversification. If you put all your eggs in one basket, you can become very wealthy if your basket is a winner. But if your basket ends up being a stinker, well, that can mangle you. So if you want to protect yourself from too much exposure to a stinky basket, then diversify your portfolio. Spread it out so you can't get mangled, which, by the way, is really easy to do if you own giant chunks of the market like I was just talking about before. Another great way to almost guarantee poor returns is to chase investment performance or trends. I won't spend any real time on this other than to say that by the time you hear about how wonderful some investment is, it's usually already had its big day in the sun. Okay, now on to the next one, market downturns. There aren't a lot of retirees who enjoy watching the value of their portfolio go down, but it is a normal part of investing. Markets do not move up in a straight line no matter how much we want them to. Economic growth is simply cyclical, so we should expect a decent-sized market downturn every 3 to 5 years. It's always worked that way. It's always going to. Expecting anything different than that is sheer silliness. But it's like I always tell my clients, none of us are putting up with this volatility because it's fun. We're putting up with it because we get paid really well to put up with it. It's profitable to put up with it, so that's why we do it. Now, you can tame this volatility by choosing a more conservative investment portfolio, but that tends to lower your long-term returns as well. So the trick is finding your sweet spot. What is that perfect level of volatility that you're willing to put up with to get the kind of return that you're looking for? And that's one of my favorite parts of my job, helping people understand how things really work and then finding that sweet spot for them. Another way to tame this risk is by building a nice-sized cash reserve, or war chest, as I like to call it. And by war chest, I just mean things like high-interest savings account, things that are not volatile and totally accessible. Basically, if markets are down and you don't want to sell any of your investments because they too are down, then you can simply take from your war chest for a while and give the markets a chance to bounce back up. Now, even if you never end up tapping into your war chest, just the fact that you have it and you know you have it does a huge amount for your peace of mind all the way throughout your retirement. This is very, very smart planning. And if you haven't seen my war chest video, you really should. The next risk is the last investment-related risk I'll touch on today. And it's kind of an iteration of the last one, but with really terrible timing. A big fat market crash right after you retire. Also known by its more clinical and nerdy name, sequence of return risk. This one can be a doozy, and the main reason is because it denies your portfolio the ability to grow in the early stages of your retirement, and that affects all the future growth as well. It can really stunt your whole plan. Simply put, it starts your journey off on really poor footing. And you hear these kind of stories all the time. You hear about people who retired and then the market crashed and then they had to go back to work. And as unfortunate as that is for some people, with a little bit of planning, you can dramatically reduce the impact that this kind of event has on you and dramatically reduce the risk of you ever having to go back to work. And the solution is pretty simple. It's the same as the last solution. Build yourself a significant war chest of non-volatile and totally accessible assets so that you do not need to sell your investments while they are down in value, which seriously exacerbates the problem. Simply live off of your war chest for a while. And then when markets come back up and go higher than they were before, which they have every single time in recorded history, you can start to live off of them again and use them to top your war chest back up. Now, of course, this solution won't get rid of the fact that you've still had bad luck in the timing of your retirement, but it will pave you a solid path through it. Now, of course, there are other things that you can do to mitigate these risks that we've just discussed that we haven't talked about, and I don't have time to get into all of them today, but here's a couple more examples. The first is by buying an annuity. When you buy an annuity, you are giving a chunk of your money to an insurance company, and in return, they promise to give you income for however long you set it up for, and usually, these are built to pay you for your whole life. It's basically the same thing as a pension. You are effectively buying a pension from an insurance company, and now, since all of your income from it is guaranteed, you no longer need to worry about market risk. That said, even though people really love the idea of pensions, annuities have proven to be really quite unpopular, and I think that's because people actually have a really hard time parting ways with a large chunk of cash. Another way you can mitigate all of these investment-related risks is to defer your Canada pension plan and old age security benefits. I've done boatloads of videos on how this works, so I won't go through it all here, but I'll summarize it like this. The regular age to start taking both CPP and OAS is age 65. But if you hold off until age 70, your CPP benefits will be increased by 42% and OAS by 36%. And in addition, both these benefits increase regularly with inflation, and the amount you get is not affected by what happens in the markets. So by increasing these benefits, you are increasing the amount of income that is not exposed to investment risk. Now, of course, by doing this, it usually means that you're going to end up spending more of your own money earlier since you're pushing off CPP and OAS until age 70. And some people hate this idea with a red-hot passion, but it is an option. And it does reduce investment risk in the later stages of your life when your appetite for market swings may be fading pretty hard. All right, moving on. Risk number 4, higher than normal inflation. Many people think of investment risks as the biggest risks that they face in retirement, and I did just spend quite a bit of time talking about them. But as unpleasant as they can be, market downturns themselves have always turned out to be temporary. The effects of higher inflation, though, are permanent. Inflation in general is the permanent destruction of your purchasing power. It's easy to think of inflation as the price of things going up, and that's certainly a part of it. But the main element of inflation is actually the value of your money going down. Your money is becoming worth less, which is a classic consequence of massive public debt and printing stunning volumes of money. When more dollars are invented out of thin air, it makes all of the dollars worth less because now there's just more of them. So it just takes more of those dollars to buy the same things that you were buying before. It's really lovely. Now, when it's happening slowly and when it's low, it's tolerable because we don't really notice that it's happening so much. But when it's high, it can hurt. And when it's high for an extended period of time, it can destroy your wealth with fury. Let me show you. Here is a plan that is perfectly solved at 100%. This couple has exactly enough investments and pensions to accomplish the retirement income goal they're aiming for. Each one of these columns represents a year of their life, and the different colors indicate the different sources of income for the year. The height of the column is showing us the amount of income they are wanting for the year. You can see that in year 1, it is just shy of 100 grand. However, each year the columns get taller. That's because we have 2.1% annual inflation built in, which is what the Bank of Canada tells us is their long-term goal. So each year, they need 2.1% more money to afford the exact same stuff as last year. But let's hop into our stress test section and stress the plan out with 1% higher inflation. Let's see what 3.1% instead of 2.1% inflation looks like. Look at that. It dropped the plan from 100% solved down to 81% solved. And it introduced a sea of red in the last 5.5 years of the plan. And that red equals a shortfall. They have run out of money and are left with CPP and OAS only. And you don't even want to know what 4% inflation looks like over the long run. Well, maybe you do, so I'll show you. It's hardcore. Inflation is a persistent erosion of your wealth, and higher than normal inflation is brutal. So how do you tame this risk? Well, first of all, you want to try to elect governments that at least have some sense of fiscal responsibility. But aside from that, if you want to keep ahead of inflation personally, then you're going to want to own assets that have the ability and the capacity to outpace inflation. And yes, that means taking on some level of investment risk. But as noted earlier, market downturns have always proven to be temporary, while the erosion of wealth from inflation has proven to be totally permanent. These are hard facts. Now, that doesn't mean you need to go full aggressive with your investment portfolio in retirement. You have to stay within the boundaries of the amount of volatility that you can put up with. And a good advisor will help you find that sweet spot. But if you are too conservative, then you will end up owning a bunch of assets in your portfolio that have a very difficult time keeping up with inflation. And that can lead to having a whole lot less income in retirement than you hoped for. Another way to mitigate this risk is by deferring CPP and OAS like I discussed earlier. Remember, these benefits increase with inflation. So by increasing the amount of inflation-protected income that you have, you can reduce the impact of inflation. You can also accomplish the same thing by using annuities, as most of them offer inflation protection as an option. You'll get less to start with if you choose this option, but the benefit will increase over time, helping to offset the impact of long-term inflation. Just note, there's usually a cap on the amount of inflation protection that you can get with an annuity, so it may not prove that helpful if inflation is significantly higher than normal. And of course, if you happen to have a defined benefit pension plan that is indexed to grow with inflation, well, that can be a major help as well. But you either already have one of these pensions or you don't. And if you're watching videos like this, then you're probably well past the age where you could just go out and get a job that will give you one. The last major risk in retirement is the risk of outliving your money, also known as longevity risk, which is basically the risk that you will live a long life. And it seems kind of weird calling that a risk, but living longer simply costs more money. And I feel like this risk is pretty self-explanatory, so I don't want to spend a lot of time on it, but I do want to stress that it is extremely wise to plan for more money than you think you are going to need, because running out of money when you are elderly is extremely unappealing. Now, I know people often use Canadian life expectancy stats as a gauge for how long to plan for, but you have to remember that life expectancy is an average, which means that half the population lives longer than that. I'm actually headed to my wife's granddad's funeral this week, and he just passed away after his 103rd birthday, and he was sharp. And fun fact, he actually collected his defined benefit pension plan from his career employer for far longer than he ever contributed to it. And that actually leads really nicely into how you can mitigate the risk of a long life. The first and most obvious is to increase whatever sources of income that you can that will produce income for life, such as CPP, OAS, annuities, and defined benefit pension plans. The other is to save and invest more than you think you'll need. Like I said earlier, give yourself some buffer. Build a portfolio that will outlast you. When we do plans for people, we always like to see them sitting somewhere between 110 and 120% on track of their retirement income goal. This gives breathing room, and it helps guard you against all of the major risks we talked about. In this case, being 114% on track put this couple in a way better position to handle higher inflation, lame investment returns, a market crash at the worst possible time, and yes, even living 5 years longer than they expected. The moral of the story is that there are some serious and real risks in retirement, but with some intelligent forethought and some planning, you can tame them.